Hi, fellow to the moon investors. I want to go through something that's really important today, and that is the valuation of stocks. Valuation doesn't have to be complicated, and of course, it is the middle or the third piece of our five-stage rocket. We begin with general macroeconomic factors, then we move into sectors and index reviews, followed by valuation, then technical, and finishing up with brand. But today it's about 5 ratios that you must know, you must be curious about before you invest in any stock. And I'm going to begin with the price earnings ratio, sometimes called the multiple. It's the granddaddy of all ratios, and it's simply the price per share to the earnings per share, but also calculated by the market cap of the company to its total earnings, or net, also known as net income. The PE ratio has historically averaged around 20 for the S&P 500 stocks. It's been drifting up to 21, 22 because of the growth of the Magnificent Seven stocks over the last couple of years. A red flag, though, is around 25. You want a ratio that's below 25, and of course, if the ratio is too low, that means that there's no confidence in the growth of the company. And it might even be a negative ratio if it doesn't have any earnings. Be aware of that PE ratio. Look for one that's undervalued vis-a-vis its peers, or maybe in terms of its past performance. The second one is also a growth ratio that you look at, and that's the price sales ratio, which is the price per share to the sales per share, or of course the market cap to the total revenue of the company. The S&P 500 average is around 2.75. Anytime you get over 5, it's getting a little frothy as well, just like the PE ratio. The third one that we look at is enterprise value to cash flow. Enterprise value is the market cap plus the debt less the cash of the firm in the numerator, and in the denominator it's the free cash flow, which is net income, adding back in depreciation and some non-cash expenses, changes in the working capital categories of the balance sheet, and subtracting away from that the property, plant, and investment from the balance sheet, or also known as the capital investment of the company. But I'm getting a little complicated there because you don't have to break down financial statements to get at that. All you have to do is look it up on the trading platform, and it's getting frothy over 40. So you're looking for a lower enterprise value to free cash flow ratio, and that really tells you that ratio about the wherewithal of that firm, whether it's a durable, sustainable enterprise, and that's coupled with the operating margin percent of the company. You're looking for an operating margin percent of 15% or more. The operating margin is the operating earnings divided by the revenue of the company. 15% or more points to a durable or sustainable enterprise, and that's kind of what Warren Buffett gets at when he talks about the width of the moat. If you see an operating margin of 15% or higher, that's a very good indicator to move forward with that company. Now, of course, it's sector specific. Walmart's is only 4%, Microsoft's is 40%. So you'd have to compare Walmart's 4% to its peers to see how it's doing. The last one we'll finish up with is debt to EBITDA. EBITDA, earnings before interest, taxes, depreciation, and amortization. It comes from the income statement. So you have the total revenue, take away the direct costs, also known as cost of goods sales. You have the gross margin or gross profit. You take away the sales, general, administrative expenses, and then you have EBITDA. Again, you don't have to figure these out. They're all on the financial websites. So you want a debt to EBITDA ratio of about 2.5 or lower. So you kind of think of the price earnings ratio, it's getting frothy at 25. The debt to EBITDA ratio is getting frothy at 2.5. It's getting a concern, actually. You want to be aware of that company's ability to fund itself. The debt to EBITDA ratio is really a leverage ratio, and if the company's over leveraged, that's a red flag. So in summary, all 5 ratios are important, but none of them stands on its own. You look at all 5 together as part of your total analysis of the company in the 5-stage rocket. So I hope that helps you. I want you to live long, climb your mountain, and prosper.